What I'd like to say upfront is the choice of this depends very much on the philosophy of the stakeholders who actually own the organization. Yeah. You spoke about my background. I mean, she spoke about my background. I worked in an organization, and I'm not going to take any names here. I worked in an organization where I've actually seen decisions being taken to deliver next quarter. Yeah, so we needed 6 pennies on the earnings next quarter, and we made a decision to lay off 600 people globally. And there was a target saying, here's the number, this is the number we got to deliver, so find the people now, you have 1 week, get it done, and next week get them off. There was also a strategic compromise, because you lost a lot of talent. You end up going and rehiring those people back in the next 6 to 9 months as things pick up. As you do this repeatedly, because it becomes a bad habit, you start compromising the long term, the market sees that, and the price to earnings multiple of that organization actually dropped by 10. It used to be 44, 45, it became 34, 35 over a 2-year period. Yeah? So it got rewarded negatively for that behavior. On the other hand, when the stakeholders who are actually responsible for the organization take a more longer term view, where it's okay if I see a drop in market cap, it's going to be 1 quarter, 2 quarters, but as long as I continue investing strategically, I'm going to create a much stronger organization. 2 years down the line, I'll be the best competitor out there on a global basis. I think these are two very different dynamics. So today, I work for an organization and the Godrej group. I think it's a familiar name for everybody out here. This group is 128 years old. There's a reason why it's that old. There's a reason why it has done multiple acquisitions and not been acquired by somebody. There's a reason why the number of companies only keep growing and only keep becoming bigger and bigger, because they think long term. And it's an absolute pleasure to work with this kind of an organization. So here, every time we have a situation, the discussion is pretty easy, because it is like, okay, so how much time to bounce back? 6 months? No problem, stay the course. No compromise on the long term for a short-term game, because the short term is exactly what it is. It's short-term. How is it going to impact anybody if there's a dip like that? Yeah, because you're coming back there eventually. Whereas if you compromise the long term to make some short-term games, I think you'll do that, and eventually you'll go back there. So it's very commonsensical the way I see it. Unfortunately, I think mindset and emotions and probably the fear of a short-term drop in valuation makes certain stakeholders and organizations make the wrong choices.
I think both of them are saying long-term and transparent communication. So Manish, over to you next. There have been, we've got an amazing IPO journey in the last 2 or 3 years. We've got about 268 listings in 2024. Probably 2025 is going to exceed that. And more than half of them lose value after being listed, right? So do you think, the valuations that are put out are doing justice to the business value?
Revati, first, thanks for having us here, Mahesh. Let me think of it from a perspective of an investor. We have a concept called intrinsic value that's closest to business value, what we think of value. Unlike Sanjay, I'm not in love with his assets or his people. It's not a fair thing to say, I need people, but I'm not in love. That's not my responsibility. My responsibility is to my investors. What Sunil was saying, we've given a lot of money back. DPR is a common word now. But for me, intrinsic value is what when I'm investing? There are only 3 things that matter. It's simple. It's the quantum of capital I get back. So it'll be a series of arrows. What is the timing of each quantum of money coming back? Third is the probability of that quantum being right or wrong. That's all there is to an intrinsic valuation. And what might change it is how I discount that cash flow for my net present value. Okay? So to give you a sense, when my friends at Chris or I invest, we have a certain cost of capital. when these large sovereigns come in with permanent capital, they have a lower cost of capital. So their intrinsic value might be larger than ours for the same set of people and assets because their perception of risk is different. Likewise, if an 85-year-old man invests and he needs his money for the next 2 years, he'll have a very high cost of capital. It won't make sense for him to invest in any of these companies. But if his grandchild who's 25 years old and has excess money, he'll have a very low cost of capital, so he'll bid higher. But that's not what we're talking about. We're talking about IPOs. I mean, no matter what I say today, I hope Navneet will very heavily invest in Lenskart tomorrow. That's one of our companies. And I think many people here have been watching the WhatsApps today, so all I can do is smile and keep my mouth shut. But no, it's the problem, the disconnect on a more serious note between what I call intrinsic or business value or market value, it's a demand and supply. So I was walking here and some young MBA caught me and said, big lecture on how can you price it on so-and-so. I said, frankly, it's a demand and supply of capital, which then sets the price. If you don't believe in that, don't buy. My father-in-law used to say that, bhai, nahi khareedna, nahi kharido. Keep the money with you. And if you believe in the valuation. Now, I think on a very serious note, if you look at our, as Kedaara's trend, and I would say for most long-term investors, I definitely agree with that. You have to price the IPO at a place where you know your... So I don't know the facts. I'm sure your number is right. But I would say all 9 IPOs that we've done in the last 14 years, and it's only 9, but that's more than most other PE firms. We've had many other strategic sales, but all 9 have gone up significantly for the next 2 years after listing. I don't know what will happen with Lenskart. I hope it will. But Vishal, which was only listed in December, factually, I can't predict the future, but I can look at the past. We priced it at 79 rupees a share in December, where we sold 20%, which we thought was a well-priced IPO. We'd made a 7x already, and we had to take money off the table. Our money is not permanent capital. We're just a fiduciary for somebody else, so we have to have the discipline giving the money back. 6 months later, 79 rupees had gone to 115 rupees. I didn't feel bad. We had sold at 79. At 115, we sold another 20%. As all we can do is control or try to influence the EBITDA and the performance. The valuation is a reflection of multiple flows of capital, globally, domestically. We can't predict or hold our horses. We can only take reactions to what the market prices, and it teaches you discipline and humility. So but I will also be honest in this room and say, we priced it that way because we sold only 20% in the IPO. 80% we still had to sell, no? So we had overpriced the 20% and the damn thing collapsed. My cumulative realization would be much lower. So main doodh ke dhule mein nahi hai. But I'm saying, depending on the context, your pricing has to be. Now, if I was selling the whole thing, my own holding, let's say there are 10 other investors, but if I was selling I would put pressure to maximize. Because again, my duty is to my share. It depends on what's your kartavya, na? Who's your duty to? And so if I was selling my whole thing, I would probably, be honest, put more pressure. We haven't ever done that yet. But I'm just giving you the 2 ends of the spectrum. It always falls somewhere in between.
So my next question is to Sunil. Sunil, a significant portion of the listed companies in India are promoter-owned, right? Probably more than 50% in terms of value in listed companies is promoter-owned, and this is very typical for India also. So given the dominance of these promoter-owned companies, how does the ownership structure impact valuation in your view?
Thank you for having me on this panel. Very interesting, I think, discussion. So see, I was on the board of CFA Institute, and I happened to sit through a presentation by the founder of Vanguard. I forgot the name of the old man. Mr. Bogle. And in US, predominantly, most companies are completely professionally owned. However, I think there is more conflict of interest there than in a promoter-owned company, because the executives are deciding how much they should make. And, I think Mr. Vishal just mentioned that the whole focus was on that quarter. And, if you are a beneficial owner, not as a promoter, but as an executive, and you have options and, you see the value of the options every day, you will always be inclined towards short-termism. A promoter is there forever. So I would believe that a proper mix of a promoter-owned company with professionalism in terms of management is the best way forward. Having said that, there are quite a lot of 100% professionally owned companies which are doing well. But I would say that having a strong promoter-owned organization with professional management, I would say is the best.
So that's the golden mix.
Yeah, that is my perception, but maybe global guys might have a very different view. But I would say that, गल्ले पे बैठा है आदमी, जो दुकान में ओनर गल्ले पे बैठा है, उसका efficiency हरदम ज़्यादा ही होगा.
So then there was a reason, and Mahesh asked this question to Navneet earlier, there was a reason why, the stocks used to behave negatively if promoters sold. And my next question...
See, it's for me?
Yeah, it's actually to Abhishek, but you can answer. So there was a time when, when promoters sold, it used to negatively impact the share price. And now today, all the IPOs have a substantial selling by promoters too. So what has really changed? And, I would love to get your views also, Sunil, after Abhishek speaks.
So, good evening, everyone, and thanks, Mahesh, for having me here. And great question, Riti. So, I believe personally, what has changed in the market is maturity of capital markets over a period of time, especially last 10 years or last decade. Navneet was articulating it very well. How markets have seen the size and scale and transition of an economy which was dependent on foreign capital to now an economy which has fair chunk of capital coming from the local markets. So certainly the maturity has come in, and similar is the resolution with the investing community. So now it's less of an optic when a promoter go out for a sale in a liquidity